Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion about something that sounds pretty simple, but it's actually an important concept in investing. And it is, what is a stock? So obviously there's a lot of moving parts, a lot of information out there, but we're going to really go into the fundamentals of what is a stock.
So because a lot of people own stocks, but very few people actually truly understand what they own. And when you don't fully understand what you own, it becomes much harder to stay confident when markets are moving. And so today we want to break it down in a way that makes it feel really clear and practical for you, because this isn't just about definitions. It's about helping you make better financial decisions.
And so we do see a lot of successful women, those that have high levels of achievement, they're high earners, they're amazing in their jobs and work. But then sometimes the investing and planning and the language about investing feels a little foreign. So we thought we'd just spend a little bit of time, like I said, going back to the basics today.
And we really want to simplify the language about investing so that you really can truly understand. And once you understand the concept, what a stock really is, it becomes much easier to understand everything else that builds up on top of it. So at the core, what is a stock? It represents its ownership. So when you buy a stock, you're buying a piece of the company. And what that means is that you participate in what happens to that business. So if the company is growing, your ownership becomes more valuable. And if the company struggles, then your investment would reflect that too.
So instead of thinking of stocks as kind of the ticker symbols or things you see,
because you think about that.
I know you see that, and you see the red or green, and you realize, okay, well, what is this? And so you really have to think of it as ownership in real businesses, and really get in the mindset of, once again, not just watching the stocks go up and down in value, but what is it that you actually own?
And a helpful way to think about this is imagine you're buying a small business. And maybe some of you are already business owners, but just imagine you're a small business owner in your community. So for instance, if you owned a local restaurant or a hair salon or a tech business, that you started, you wouldn't check on its value every day, or every hour. What you would look at is my business growing? Are my customers coming in? Do I have business? Is my business actually making a profit?
And so when you think of the stock market, obviously the prices fluctuate. And obviously when you see prices fluctuate, there could be stress that comes along the way when you think, well, am I in the right investment and what is this? And so owning stocks, you can own stocks a few different ways. One is you can own an individual company where you own shares of ownerships of a company. You can also own stocks inside of a mutual fund. A mutual fund is a pool of stocks, so you could have a mutual fund that has several stocks in them. And there's also what's called exchange-traded funds, which are ETFs, and those are a pool of stocks. So it's not, obviously we're talking about what is a stock today, but there is different ways that you can invest and buy stocks. And so when you kind of look at stocks, there's two ways stocks create wealth. And one of them is growth. So if the company is growing their earnings and they're obviously expanding, then their value will grow over time. So that's one kind of type of stock that we tend to look at.
And the other type that we often look at, and a lot of people moving into retirement really like these types of stock, but they own stocks for income. So some companies, as Catherine said, are growing, and some companies pay dividends, and sometimes there's blends. So when you think about the dividend, it's essentially you're sharing in the profits of the company with the other shareholders.
So you may have a combination of the two. So you have growth and income. We also call those value stocks. And so as those stocks are continuing to grow, once again, what's the purpose of the stock? What's the intent in your overall plan? But usually we do see clients that have growth stocks and value stocks on a combination of the two.
And so historically, stocks have really been one of the most powerful long-term wealth building tools. And this is really where expectations matter, because stocks don't grow in a straight line, just like any business that's out there. So let's make this real with a simple example. So if someone invested in the broad market portfolio over a 20-year period, you'd probably experience several downturns along the way. So it's not just going to be a straight line.
And in investments, then obviously you should have a plan that works, and yes, your stocks will fluctuate over time.
So let's talk next a little bit about why stocks actually move. And stocks move for a lot of different reasons. Number one is company performance. So P&E ratios, so price to earnings ratios, or free cash flow, earnings per share growth. There's a lot of things about company performance that you want to be looking at when you think about stocks. Also, you want to look at interest rates, economic data, and global events like we're experiencing right now. Those cause stocks to move. Also, in just investor sentiment, because people are emotional.
Yeah, I know. And so with the big movements in the market, obviously, we understand or know there's usually a reason behind it, but sometimes they're emotional and you get into that mode of, I need to do something, fight or flight, or what's going on. And it could be scary if you don't, know why or how you're positioned with your money. And obviously the growth part, it can fluctuate, but the idea is over time, growth and income stocks do well historically versus some of the other investments that are out there, at least the fixed income, more conservative investments. And so as we're seeing the headlines and we're seeing the markets fluctuate, and so we obviously want to, look at what's the fundamental of the stocks that you own. Has anything changed? Because it's not a matter of buying and selling or making major changes because of a market condition or something that's happening in the world. It's really looking at what is the business and is there anything that's shifted there before you make some moves.
And are the fundamentals strong? But because markets react really quickly, and we've seen that, the markets can be way down and then they can be, they move back up really, really quickly. And so you don't want to be jumping in and out of the markets. But businesses evolve more slowly. So again, like we started, stocks, you have to think about it as a business and what's happening with that company, that business. Are you looking at the fundamentals like Catherine said? So understanding the difference between the fear and the uncertainty and actually the fundamentals of the business is really important because it'll help you react in the short term.
Yeah. And so as you see short-term price movements, those don't obviously usually reflect long-term value. So it is important to look at price and value and kind of see where are they at, and they're typically not the same. So the price might be down a little bit, but what's the value, and is it reactive because of a market or uncertainty or a war or something that's happening? And once again, events and crisis happen all the time. It's just a matter of getting through that, and like I mentioned, historically we've seen corrections over the years, and so we do believe in the reason why we believe in having some growth or stocks and growth and value stocks is because a lot of our clients, they're living a long time and we want the money to last, or also some of our clients want to leave money to their beneficiaries and in their estate. And so that's why we do have that growth portion.
It's important to keep up with inflation too.
Oh yeah, for sure. And inflation's a real thing. We feel it all the time.
Especially right now.
Yes.
So let's talk next about risk and understanding risk, because this is where a lot of investors get uncomfortable because owning stocks means accepting volatility because the market is going to move. Prices are going to go up and down.
And so there's several different types of risk. There's the market risk, there's company-specific risk, economic risk, interest rate risk, which you touched upon. So once again, there's a lot of different risks that are out there and things that come up. And so we're not going to be reactive to some of these risks, but we know that those risks are there. And so when we design kind of our investments and put together our investment strategies, we do factor in, longer term, what's the plan and purpose of the money. And for the growth part or the stock part of it, we do know there's some risks that come along the way, but we are managing that and looking at that for all of our clients.
And one of the biggest risks we see is concentration, and this is especially when someone holds a really large concentration of one or maybe more stocks in one company. So, and this becomes really important if the company is also your employer, so you're receiving maybe stock options as part of your equity compensation. So now all of a sudden your income, your paycheck, and your investments are tied to the same source. And we've worked with a lot of clients who've had a significant portion of their net worth tied to one company. And everything felt really fine for them until it didn't.
I was going to say, when your compensation's impacted and your stock value's declining.
It's scary.
Yeah, and then there's some uncertainty in, once again, how much concentrated stocks you have with that company, and what, how does it tie in overall with all of your other stock positions. So yes, there definitely that's definitely could be a risk or something to review.
And that's why diversification it's not really about reducing opportunity, but it's about protecting about what you're building or what you've already built.
So let's talk a little bit about public and private companies. So when we are talking about stocks, a lot of the times what we're looking at are public companies versus private. But public companies are traded on the exchanges, which means that we can buy shares, we can invest in individual stocks, or once again, what I mentioned earlier was there's other ways you can participate in stocks if you don't just own individual stocks. So there's the mutual funds and exchange traded funds and some other investments you can buy as well.
And then you have the private companies, and these aren't publicly traded. So the ownership in these is limited, and what comes along with that is liquidity is restricted. So what you need to keep in mind is, this matters to you if you are receiving stock compensation or if you're involved in a private business, because the value might look really significant, but the access to that value might not be immediate.
And then once again, as we work with some clients, we often see they have equity compensation with some of these private companies where they receive shares or stock options. And so the value, when you get these might be extremely high. But we also have seen potentially if there's a change in the company, there's a liquidity event, or if there's an acquisition, it's great if everything goes in your favor, but there's also the other side of it. We've seen the other end of it where it goes sideways.
Mm-hmm.
So once again, it's important to know how much you have and what those look like and how it fits in your overall allocation.
And part of the planning is not just understanding what you have and what it's worth, but when and how you can actually use it.
So let's talk a little bit about how stocks fit in your strategy. So obviously, investing in stocks is one part of an overall investment proposal and strategy that we work on. And usually we're looking for stocks for growth. However, once again, there's the growth stocks and value stocks. The value stocks, like we mentioned earlier, pay dividends. And a lot of clients like that because it's income coming into them, whereas growth stocks, the companies are putting money back into their businesses so they can grow. So there's two different styles of stocks. Obviously, having a combination of the two is usually what we see. But there's some other investments that we typically look at to balance out the investments. We look at fixed income. We look at cash reserves and emergency funds. If you qualify, there might be some alternative investments we would review. And then once again, all of this depends on your own situation, your goals, your timeline, your time horizon, your comfort with risk. And once again, that really kind of goes back to kind of doing financial planning and investing and seeing how those kind of come together and what is your overall goal and purpose, and then we put together the strategies to go along with that.
But it also has to do with what season of life you're in, because if you're still working and you're building wealth, you might have a higher allocation into stocks. But also you have more time to ride out market cycles. Whereas if you're approaching retirement or you're getting closer to retiring, you may want to shift to a different approach, maybe a different balanced approach. Not because stocks are bad, but because the role for your money is changing. So you're going from growth, not to say you don't need growth, because you need that because of inflation and other things, and people are living longer, like Catherine said. But also you want to have some income potentially coming in because you no longer have that paycheck coming in, and you want some more stability potentially.
So let's walk through a couple common mistakes that we see. One is reacting emotionally to market swings. It's interesting. We've had calls over the years. Recently, I haven't seen, the sentiment hasn't been where people want to jump in and out completely, but I think there's definitely has been some concern about the wars and what's the impact. And
they want to know what we're thinking.
Yes. And so what's the plan or where am I at? But I haven't really seen a lot of reaction of I'm going to get completely in and out of the market, that emotional swing. But definitely those are conversations that we have. And then another common mistake is treating stocks like a short-term trade. So if you are, if you see it go down by 5 or 10% or more, and you want to get out, then obviously looking at are you in the right risk allocation? Is this appropriate for you? And having those conversations is important. I think we talked about over-concentrating in a position. So that does tend to happen if you are employed and you get stock options, and just making sure, once again, if your company's great and it's wonderful, we're happy for you, but just making sure that you're diversified and have a plan for that. And then not understanding what you own. So once again, we talked, there's different styles of stocks and purpose. And so really understanding not only I just own stocks, but what kind of stocks do you own and why, and how does that tie in with your overall allocation? And then not chasing performance. I mean, obviously there's a lot of stocks out there that are doing very well, and which is great if you own some of them. But you can't go and say, "Oh, this is doing well. I want to go buy this X, Y, and Z." It's really a matter of what kind of strategies do I have in place. And yes, we want you to make money, but we also want to be mindful of how we're doing that for you.
And one of the biggest mistakes we see is confusing movement with meaning. And just because something's moving doesn't mean that something fundamental has changed. And so, for instance, oftentimes we see someone selling after the market declines, and then they wait too long to reinvest and miss the upside. And so in that process, if you miss that recovery, this can have a bigger impact on long-term returns than the decline was itself. So just because the market's going down doesn't mean you just really need to be focused in on, do you have the right allocation? Are you properly, have we identified your risk tolerance correctly? And just really understanding what you own and what it's supposed to be doing in your portfolio.
Exactly. And having a better framework of what is a stock, and obviously thinking about, what's the purpose and why it's there. I think that's important.
So what's the better way to think about stocks?
So basically it's ownership in businesses, and obviously we want to have long-term growth. We want to have diversification. And like we mentioned earlier, a lot of clients, usually when they're phasing into retirement, we have the conversation, they think I need to be more conservative, really, really conservative. Yes. But the reality is, as we talk through and realize the different phases of retirement, and having the money last, we usually have those discussions on, yes, there's the understanding of there does need to be some growth there too.
And having the ownership in stocks, and you have to think about it as ownership in businesses, and you're holding it for long-term growth, you really want to have a diversified strategy. And these stocks are not something that you're going to be reacting to daily. Just like we said at the beginning, if you owned your own business, you're not going to be focused in on that. You're going to be looking at, is it profitable? Do I have customers coming in? And is it doing well?
Yeah. So while understanding what a stock is may seem simple, it is important to understand, once again, what's the purpose and why, and it is a building block to help you in your financial future. And so we definitely feel that it's important to learn and understand what it is that you own.
Because if you understand what you own, you're going to make better decisions.
Yes, and we want you to make good decisions for yourself. And we know we shared a lot, kind of going back to basics of what a stock is. We're happy to have a conversation with you about your own individual situation and see how this ties into your investment plan and proposal. If you have any questions or want to have a further discussion with us, you can reach us at 760-692-5700. That's 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.